now is Tony Dwyer, Canaccord Genuity Chief Market Strategist, and Jeff Sherman, DoubleLine Capital Deputy Chief Investment Officer. We've got bonds and stocks covered for you in this segment. Tony, first to you, because, you know, as you said it in your note, it never feels, everybody calls for a healthy and normal correction, and it never feels that way when you're going through it. So the NASDAQ is now off, what, 5.25% from the highs? Is it healthy and normal?
I think it is, and some of the evidence of that is, I think Jim covered it earlier in the show, Jim Paulson, where this is actually kind of an offensive tape on a relative performance basis. The market is really, Sarah, I think it's so important to define, quote unquote, the market. If you're defining the market as the S&P 500, it's really been driven by the mega cap theme throughout the summer, and everything else was suffering. You can use the McClellan Summation Index, you can use the NYSE Advanced Decline Line, the NASDAQ Advanced Decline Line, the Russell 2000, the mid cap. So in other words, it really has been a broad, I don't want to say even pullback, consolidation, correction period. And now the mega cap stocks are catching up to that theme. Remember, the S&P was down about 5% a week ago into that Monday move. We're nowhere near having the same number of stocks pulling back to the same degree as last Monday. Last Monday, we only had, I think at the close, it was only 8% of stocks in the S&P 500 were above their 10-day moving average. The reading before I came on the show was in the 30s. So, you know, I don't want to drone on too much, but I think the broader market is actually acting better than it did last week, even with such a bad day.
And better than certain sectors like utilities and materials and real estate and communication services, all down 5 to 8% from the highs. Jeff, want to get to you on this big bond move. What is it telling you? Is this Fed driven? Is the debt ceiling in there? How are you interpreting it?
Yeah, I'm not thinking too much about the debt ceiling, although that's on people's minds over the next couple of days. I still think this is Fed related. I mean, Jay Powell last week, as I said on the show on Friday, he let the cat out of the bag, and he said that, you know, we've essentially achieved our inflation targets. And you look at something like the housing data come out today, you have a 20% year-over-year increase in the Case-Shiller home indices today. And so what you're seeing is just signs of inflation in really every capacity. And one thing that you haven't seen in the inflation data is the contribution from the housing component. And it's still running at very low levels, and that's something we think trickles into the system next year. But look at what's happened into the pricing. It's not just the 10-year or 30-year, and I know we focus on that a lot, but we've seen this line in the sand with the 5-year. And the 5-year, which is thought to be the health of the economy and the barometer there of the economy, has now shot up past 1%. And again, 1% is nothing magical about it, but all of a sudden you're seeing a repricing of inflation expectations, as well as potentially bringing that rate hiking cycle forward a little bit. And that's what you're seeing in the curve. So why you also see this in some of the credit sensitive assets is that within the bond market, things like high yield and some of the securitized products are priced closer to that 5-year part of the curve because they just have less interest rate sensitivity. So what I interpret here is this is the idea that, you know, the Fed's going to be stepping back, the economy is going to continue to do what it's going to do, but also we're going to be living with a higher level of inflation than we saw pre-pandemic. And if that number continues to hover around, let's call it 3 to 3.5%, then again, bond yields need to adjust, and that's what they're starting to do.
But Jeff, does this just bring forward by a few months, a few Fed meetings, that the tightening that was going to happen anyway? Or have you significantly increased in your mind the chance of a major Fed policy mistake that's taken place and that they're going to be rushing to hike rates next year?
No, I mean, it's a great point, Wilfred, and this doesn't change my view. I still think that the Fed's going to be hard-pressed to be hiking rates next year. They've got to get out of the bond buying program. And look, they've got a lot of wood to chop there. They're currently buying $120 billion a month. They're talking about reducing, if you estimate, 15 to 20 billion reduction each month in those purchases. And that will have a marginal impact on the market. So I think that's really what the market is thinking about, is the speed of that taper and how they're going to withdraw these purchases from the market. And remember, that's still an accommodative policy. They are still buying bonds. So it's not that they're just stepping away from the market and letting it float on its own. However, the idea of the hiking cycle, you know, Jay has switched tunes. I mean, he was really very dovish at Jackson Hole. He focused on the labor market, the challenges there, and saying that, yeah, we've hit our inflation target. Now he's not even talking about anything dovish. He's starting to say, okay, we're going to start this process of getting out of bond purchase. It's going to take us a while. They're not unwinding the balance sheet. They're not hiking rates, but the bond market's starting to say, wait a second, we have to take Jay at face value. And I think that's really what you're seeing here. And yields have been depressed over the second quarter, and really, over the third quarter for most of this period. And now, when he changed his rhetoric, everything's changed.
He really did change his rhetoric in the last Fed meeting. So, Tony, what do you do? Equity investors, should they buy on the weakness still into year end? I think you were calling for a recovery.
Yeah, we've been talking about the summer of indigestion transitioning into the year-end opportunity, and we've kind of coined it the banks, tanks, shanks, and cranks, meaning the financials, the industrials, the materials and metals, and the energy space. So, you know, if you do have higher yields, it comes with better economic expectations. And I think something that Jeff said was really important. Where the evidence exists that this is good economic backdrop, without massive inflation pressure that's going to cause the Fed to all of a sudden start hiking. I don't think they're going to hike rates for the predictable future. There's too much debt. But what you do get are these periods where you have a little bit of economic enthusiasm, and we're seeing that on a relative basis. And we know that because the inflation break-evens, the 10-year inflation break-evens, are up less than the 10-year U.S. Treasury yield. And that's kind of unique to this year. The inflation break-evens have been moving up, or had been moving up earlier this year when the rates, remember when, Sarah, when the rates got up to 1.74%, obviously that was predicting the explosive growth that was in front of us. And last time we were on the show, we were talking about how maybe the 1.12% earlier this year, it was predicting the Delta variant. So maybe 1.59%, we're just normalizing that situation. And it's not this massive inflation spike that's going to cause everything to go to zero. So I think economically sensitive areas are the place to be into year end.
Just quickly, Tony, is the buying opportunity in those names there today, right now, or you're saying you're going to get a better buying opportunity as this current pullback kind of grows into itself over the next couple of weeks?
Yeah, I think we're in the beginning of it. I think you can add a little exposure, especially if it's a relative trade. Remember, Wolf, we're in institutional advisors, and most of them are fully invested, so it's sector allocation on a relative basis. And I think that you have seen a turn in the economic recovery theme relative to the S&P 500 because they're dominated by the mega cap growth theme. So yeah, I think we could start looking at it that way.